This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. Happy to have you with us as we continue to rock and roll through the semester. Fall 2024 semester, we're making progress, aren't we? We are already in week 10, if you can believe that or not. There's not a whole lot of time left in the semester, so I'm happy that you're with us today, especially as we explore a really important concept called depreciation. Very, very important for you to understand how depreciation works. This affects everyone, especially for those of you in business. And if you have assets, it greatly affects you. It also affects you personally, and you maybe don't think about it this way. But with depreciation, if you have a vehicle or a house, it affects you. Depreciation affects you. What I mean by that is that property, plant, well, I shouldn't say property, but plant and equipment, or a house and a car, depreciate in value over time. What that means is that the value decreases over time on the physical building and on the vehicle. And the reason why that is because as things get older, they tend to break down a little bit more. It's kind of like us as humans, right? Like, now that I'm a little older, my knee don't work the same way as it did before. The same, right? The same concept applies with your house and your car. It gets older, stuff starts breaking down, right? Just this year alone at my house, I had to replace my hot water tank went. Um, the well had some problems. The AC unit had some issues. And I'm thinking to myself, I'm like, what the heck's going on here? Why all this stuff breaks down? You think about it. They're all machines. These are all mechanical things. The hot water tank, that's a mechanical thing. The air conditioning unit, mechanical thing. The well, mechanical thing. These things break, okay? Anything that is mechanical will break down eventually. The same with your vehicle. It's going to break down. How do you know, Dr. B? You don't know how I drive. You don't know my car. I know it's going to break down because it's mechanical. That's what mechanical things do. So that's why things lose value over time. They get older, they break down. Simple. Okay? Now, of course, it doesn't lose all of its value, but it does lose a good amount of it over time. Housing is a little bit different but I'm going to talk about that when we jump into the lecture. But I want you to think about those things because when we take care of our taxes and when we talk about depreciating assets, it affects you in one way or another. So all I have to say is we're in week 10, fall 2024 semester. What we have for this week is a hypothesis assignment based off of planned assets, and we also have our quiz related to this chapter. So the two action items you have for this week are your hypothesis and your quiz related to property, plant, and equipment and depreciation of those of fixed assets. So let's talk about it. Let's jump into that conversation. And I'm going to use as much real life application as I can because I really want you to understand this concept. It's really, really important. This is probably one of the most important aspects of accounting. And so because of that, it's going to affect you individually and it'll affect your business. And so understanding it is really important. So we've heard these terms before, property, plant, and equipment. And I know that you've seen it on the balance sheet already. We call these things fixed assets or long-term assets. And the idea is that we used our fixed assets or long-term assets to help the business to generate revenue. So I use my factory, I use my equipment, I use my vehicle, I use my land to help the business to generate revenue, right? That's the idea here. That's what property, plant, and equipment is. It's a long-term asset used in the business to help us to generate revenue. The building, the machinery, the vehicle, very important things. Those are all fixed assets. So it's important to understand that these things over time, they tend to break down. Okay, they get older. When things get older, they break down. They're not as useful, right? They're not as useful. The shop a little bit more. It needs a little bit more maintenance. So it's just not as useful. So we're going to talk about this concept called depreciating. So here we have kind of a clear definition of property, plant, and equipment, fixed assets. They're tangible in nature. You can physically touch them. They're used in day-to-day operations of the business, and we expect to use them in order to generate revenue. That's the expected future benefit, right? We use property, plant, and equipment to help the business to generate sales, revenue. Call these property, plant, and equipment. And that's what it's typically defined as on the balance sheet, or fixed assets. Plant and equipment, well, actually it's just plant and equipment. They lose value over time because they get older, they start to break down. They're just not as useful. So they use what we call their useful life. It's different from when we buy things new, right? You go to buy a brand new car, everything's all fancy, it's all shined up. You know, it's got a lot of pep in that step, and it runs real well, you know. Then you drive it off the lot, and it loses value because you drove it off the lot. You're putting miles on it, you're using it, it's got wear and tear. And then over the first year, it loses more value. The second year loses more value. Third year loses more value than 4 years and 5 years, until it reaches what we call the end of its useful life, at which point it's considered to have no value, although you're probably still using it. That process that I just described is called depreciation. So we have to compute depreciation, right? And we do that a couple of different ways. The first thing we need to do when we acquire a new asset, fixed asset, is we need to record its cost, what it cost us, the business, to acquire. Now, acquisition cost is not just the purchase price of the new car or the new dump truck or the new building. It is the purchase price plus the additional stuff, the insurance to get it to us, the shipping cost, the installation cost. We add those things together. That's the total cost of the acquisition of the asset, okay? But just to keep things simple, let's think about a vehicle, okay? Let's say the company is buying a new company car, and the company car costs us $25,000, okay? So our acquisition cost is $25,000. Simple, you know, $25,000 out the door, right? That's our acquisition cost. So we debit vehicle asset $25,000, and we're probably going to credit notes payable $25,000 because we're probably not paying all that up front. We're going to pay it over time through the loan, right? So notes payable $25,000. So that helps us record our acquisition cost. That's step one. Then step two, we're using that vehicle over time, okay, for deliveries or for whatever. We're using the company vehicle. So at the end of each year, I know that I'm using that vehicle and it's losing its useful life as I use it. Why? Because it's going to start breaking down over time. I'm adding miles onto it. It's going to require a lot of maintenance. Therefore, it's losing its usefulness, right? So at the end of each year, I need to record the loss of that usefulness. And we do that through what we call depreciating. And so what I'll do is at the end of each year, I'll debit an account called depreciation expense. And it'll be by an amount that the government tells us, or it'll be one of four methods. And we're going to talk about those methods. And I'm going to credit an account called accumulated depreciation for that vehicle. So I bought the vehicle for $25,000. It has a useful life. According to the Internal Revenue Service, the IRS, they publish a report every year. It's called the Makers Report, M-A-C-R-S report. Okay? And this report tells us, business people, how long things should last. For a vehicle, the IRS says that this vehicle should last 5 years. Okay, 5 years. That's it. We already know it's going to last more than 5 years. We know that. But for tax reporting purposes, it lasts for 5 years. Right? I bought it for $25,000. Its useful life is 5 years. And I can depreciate this asset using what we call the straight line depreciation method. What that simply means is that I'm dividing the $25,000 across the 5 years, minus any scrap value if there's any. Okay? So let's say there's no scrap value. It's just $25,000 for 5 years. That's 5, 10, 15, 20, 25. That's $5,000 a year that it depreciates in value. So at the end of year one, I would debit depreciation expense, $5,000, credit accumulated depreciation, vehicle, $5,000. Okay, so that's the second step, essentially. And the third step, any related expenses like repairs and maintenance. And then at the end of year 5, at the end of the vehicle's useful life, I record the disposal of the asset, or I just take it off of my books by fully depreciating it because it's reached the end of its quote unquote useful life. Although businesses still use them, we just don't depreciate it anymore at the end of the 5 years. Okay, I'm just try to remember that example because I'm going to keep bringing that one up just to make things easy for us to understand. So as we mentioned, the first thing we do is we need to compute the cost of acquiring the vehicle or the asset. Now, the acquisition cost, we do this for the 3 items. We do it for property, plant, and equipment. However, it's important to note that the only thing we never, ever depreciate is land, the property. Land, the physical dirt underneath the building, that does not depreciate in value. Land is considered infinite. Land is considered infinite. I know it sounds silly to say that, right? Because, we don't know how long the earth is going to be here. We don't know if the ground's contaminated. We don't know if there's issues, related to that. But for accounting purposes and tax purposes, we consider land, the ground, to be infinite. And because it has an infinite life, we don't depreciate land, if that makes sense. The reason why that should make sense to you is I want you to think about the value of your home. If you own a home, you notice that it goes up in value every year, even if you don't take care of the physical house itself. Now, why do you think that is? Can anyone tell me? Why do you think the value of your property goes up every single year, even if you don't take care of the house, the structure? Any thoughts?
The space itself is valuable. like the land itself is more valuable even if you don't do upkeep on the home?
Yes, 100% correct, Nero. You nailed it. That's the exact reason. So, so if some of you might be on the housing market, okay? So you're on the housing market, you're looking for a house to purchase, some land to purchase. It's a great investment. And the reason why it's a great investment is because the land always going to be there, always going to go up in value, even if the structure that's on the land is not. You see? The land is what's valuable, not the house that's on it. That's why the value continues to rise every year. Very good. I'm glad you know that now. That's an important thing to, you can talk about that one at the Thanksgiving dinner table. They're like, hey, you know why your house value keeps going up? They're gonna be like, no, why? Because the neighborhood's real good. Like, no, it's because your land's valuable. But it's a good conversation. It's a good thing to know. So let's think about the acquisition, right? So let's say we're purchasing a piece of machinery or equipment like a car. Purchase price 25,000. Is it or let's say the purchase price is 20,000, but there's other things I got to do to add in the additional 5,000. Total price is 25,000. The purchase price is only 20. The other 5,000 comes from the tags, the registration, the insurance, the uh, inspection, the getting it readiness, all that stuff that has to happen. That equals the additional 5,000. You see what I'm saying? So all those things together equal the total acquisition cost. It's the purchase price plus all those extras: insurance, installation, shipping, testing, etc. Altogether equals that total acquisition cost. So, example for a piece of machinery, it's the purchase price plus taxes, plus transportation charges to getting it to you, plus the insurance while it's in transit, plus the installation, plus assembly, plus testing, etc. Yeah, that's for machinery and equipment. For buildings, it's the cost of purchasing or constructing the building, plus the brokerage fees, plus the attorney fees, plus the titling fees, plus the taxes. Okay, all those things together equal the total cost of the building. When it comes to land, there's the purchase of the land, but it's also the land improvements. I purchased the land, great, but that's usually not all I do to it, right? I put in a driveway, a parking lot, fencing, sidewalks, lighting. All of these things I do to the land to make the land look better, but those things also add to the value of the land. You see? The more you take care of the land, the more valuable the land becomes. So the total cost of land is the purchase price, the legal fees, the surveying fees, property taxes, real estate commissions, and titling insurance, etc. All those together equal the total cost of the land. As I mentioned earlier, land is not depreciable. You cannot depreciate land. Land is considered infinite. Land is considered infinite. It's always going to be there. There might be a building on top of it, but below the building is the land. The land is always going to be there. Okay? You might have to do things to it to get it into good condition, but the land is always going to be there. So because land is always there, we do not depreciate land. Sometimes purchasing land and other stuff can be done together. In fact, most of the time it is. And this is true for an individual who's buying a house or a company that's purchasing a building that already has land, right? We oftentimes purchase the two together. Well, the house is on the land, so what am I buying? The house or the land? I'm buying both. When I bought the house, the land was already there, so I get the house and the land. You see? So we need to make sure that we properly allocate the cost of both the building and the land together. You can't just lump them together, right? Because they're two different things. The building is not the same as land. Land is not the same as a building. See, two different things. So we got to separate them out. We go through what's the appraisal process to figure out the relative market price, okay, of both the building and the land. But I got to make sure that I separate those two out. So here we have an example, CarMax. I'm sure you've seen one of these places. They sell used cars oftentimes. They have a pretty big lot. People come in, they sell their car to CarMax. CarMax sells their car to someone who needs it, right? So that's their business, right? So CarMax, as an example, is a dealership, and they're looking to purchase a new dealership location. The building already exists, and it's on top of land, right? So they hire an appraiser that says, hey, here is what the land is worth, here's what the building is worth. Okay, great. So we enter in our accounting system, we enter in the value of the building and the value of the land. We do that separate accounts, yeah? And so the assessor comes in and says, hey, the building is worth $60,000 and the land is worth $40,000. Okay, great. So it's $100,000 total. So I enter in $60,000 for the building, $40,000 for the land. That's $100,000 total. So CarMax, for the purchase price, they're getting a deal here. All right. The person selling the land and the building says, hey, you know what, CarMax, I'll make you a deal. I'll give you $10,000 off the asking price. $10,000 off the asking price. Okay, so sell it to you for $90,000 cash money. Okay, great. So CarMax is getting a deal. So CarMax says, okay, I'll give you $90,000. Now, you can tell just by looking at these numbers that that's $10,000 below the value. So CarMax is getting a deal here. They're buying below value. Awesome. What they do is they need to apportion the cost for both the building and the land. So what they do is they take the total price that they're paying, $90,000, times the percentage allocation. Percentage allocation is 60% for the building, 40% for the land. How do we know 60-40? You might be wondering. Well, the appraiser said the building is worth 60 and the land is worth 40. Together, that equals 100,000. 60,000 out of 100 is 60%. So that's where those percentages come from. Yep. So we take the 90,000 times the 60% to get 54,000 is the apportion cost for the building, and we do the same process for land. 90,000 times 40% is 36,000. So 36,000 is the cost of the land. And then so I make a journal entry. I debit building 54,000, debit land 36,000, and credit cash 90. What that journal entry does is it adds the fixed assets, building and land, onto my balance sheet, and I'm reducing my cash. So I'm increasing my fixed assets, building and land, and reducing my current assets, cash. You see? That's how we acquire property, plant, and equipment. That's the type of entry we would make. Now, as I mentioned, when it comes to a building or a piece of machinery, these things break down over time. And because they break down over time, they lose their usefulness. And so we call that process depreciation. I'm going to show you a couple of different methods of calculating depreciation. The first is called the straight line method. The next one's called the units of production method. And the third method I'll show you is called the double declining balance method. These are the three most commonly used methods by business, all of which are accepted by the Internal Revenue Service, the IRS. And each method has its own benefit as it relates to taxes, and we'll talk about that. So first, the simplest one we'll talk about is depreciation. But before we get straight line method depreciation, before we get to it, what is depreciation? It's the process of allocating the cost of the plant asset to expense in the accounting periods benefiting from its use. Fancy words, okay? All this means is we're taking the cost of the fixed asset, the building or the equipment, and we're spreading it across its useful life. Because it loses its usefulness, it loses value. Simple, right? Simple. That's all. That's what that means. So we're spreading the cost of the asset, acquisition cost of the asset, over its useful life, and we're expensing it out. So at the end of each year of the useful life of the asset, I debit depreciation expense. That's an expense account on our income statement. And I credit accumulated depreciation. Accumulated depreciation is what we call a contra account, and it is a negative asset account. Negative asset account. I know it goes against the equation, doesn't it? Here's why we do it this way. You cannot just reduce the value. You cannot just reduce the value of the asset from the balance sheet. You can't do that. It doesn't work that way. So we have what's called a contra account that is a negative, a credit balance asset account that reduces the value of that asset. It's directly tied. I'll show you what it looks like. So, a couple things we got to do before we can calculate depreciation methods. The first we do is we got to figure out the total cost of the asset. Remember, total cost is the purchase price plus all of those other things. Insurance, getting it to us, so transportation costs, etc. Any type of other related expenses like surveying, well, I guess for building, surveying of the building, construction costs, maintenance, not maintenance, but the installation, etc. All those are our total landed acquisition costs. The other thing I got to figure out is its salvage value and its useful life. The salvage value is what we believe the asset will be worth at the end of its useful life. Okay, think about it like the trade-in value or the residual value or the scrap value. Think about that car, that car example I gave you earlier. We bought a car for $25,000. Okay, it has a useful life of 5 years, according to the maker's report. Car purchase $25,000, useful life 5 years. I depreciate it every year for 5 years by $5,000. Simple. I then find out that the car will have a salvage value of about $1,000 at the end of the 5 years. That's $1,000 that's not how much it's worth at the end of the 5 years. That's simply what I can get from it if I scrap it. Okay? Get $1,000 in scrap value. Bring it to the scrap yard, get $1,000. Right? That's what we call salvage value. And of course, the third thing being useful life, that's how long we expect things to last, how long it'll be in service, serviceable life. Again, oftentimes this is given to us, and it's given to us by the IRS through the Maker's Report. So I'm going to use this example to help to explain all three commonly used depreciation methods. First, we'll do straight line, which is very simple. Then we'll do units of production, and then we'll do double declining balance. I promise you, all three of these are very easy. It's just a matter of kind of remembering which one is which. Okay? So here's the data we have for this. And this comes from a manufacturer who makes pairs of running shoes. Okay, we'll say maybe it's Nike or Adidas or whatever. Okay, they make running shoes, and they need to purchase a new piece of machinery to help them to make more shoes. Sounds very logical to me. So here's the machine that they're looking at purchasing. It'll cost the company $10,000 to purchase the machine. The machine will have $1,000 salvage value at the end of its useful life. We expect the machine to last 5 years. So, the first thing I need to do is figure out my depreciable cost. I take the total cost minus the salvage value. The reason why we do that is because the salvage value is what we expect to get at the end of the useful life. We're not going to depreciate that, right? So we take the total cost minus the salvage value to get the total depreciable cost. In this example, $9,000. 10 minus 1 is 9. We have an expected useful life of the piece of machinery for 5 years. We get that from the IRS. That's what they told us. And over the course of that 5 years, I expect to be able to make 36,000 pairs of shoes. Okay, great. So that's the data we're going to use. Let's first do straight line depreciation method. So using that data from our example, the cost is $10,000, the salvage value is $1,000, useful life 5 years. Okay, so I take my cost minus my salvage value. 10,000 minus 1 is $9,000 divided by useful life. 9,000 divided by useful life of 5 years gets me $1,800 per year. At the end of each year for a period of 5 years, I am going to debit depreciation expense $1,800 and credit accumulated depreciation for machinery of $1,800. Now remember, I had said earlier that accumulated depreciation is a asset account that holds a credit balance. An asset account that holds a credit balance. It's very unusual to see that. But the reason why we have an asset account that has a credit balance is we call this a contra account. It is contra flow to the asset. That's why we call it accumulated depreciation machinery. We have an account named machinery. It's an asset account. It's called machinery. And it has a current balance of $9,000. Okay? Now I have a credit balance asset account that says accumulated depreciation machinery for 1,800. That equipment balance on my balance sheet is always going to have 9,000 until the machinery reaches the end of its useful life. Then we'll take it off of the books through disposal. I'll show you what that looks like when we get to it. Just wanted you to be aware, okay? So I make this adjusting journal entry at the end of each year for a period of 5 years. That's straight line method. It's that simple. It is that simple, okay? Here's what it looks graphically. You see the 5 years. Each year I debit depreciation expense 1,800 and I credit accumulated depreciation 1,800, okay, for the 5 years. On my balance sheet, I see the piece of machinery posted at $10,000 because that was the acquisition cost, minus the accumulated depreciation 1,800 plus 1,800, 36, and then it keeps adding up, right? So end of year 2, my machinery should be worth 6,400. On the right side, graphically, we see the value, the book value of the machinery. Started at 10,000 when we purchased the new machinery less accumulated depreciation of 1,800 per year for 5 years. At the end of its useful life, which happens to be next year, the machinery will be worth $1,000. And remember, $1,000 is our scrap value. You see? This is what it looks like from a chart perspective. So here on the chart we have our years. We purchased it for $10,000 in 2020. And then over the 5 years, we depreciate it by 1,800. So we take depreciable cost minus the 1,800 to get the book value for that year. Depreciable cost minus the 1,800 to get the book value for that year. You see? So we started at 10,000. Then at the end of the first year, it was worth 8,200. Then it was worth 6,400. Then it was worth 4,600. Then it was worth 2,800 at the end of this year, and at the end of next year, it'll be worth $1,000. But you can see how that works, right? That's why we call it straight line. It's the same amount every year over its useful life. Straight line. It goes in a straight line. That's why we call it that. So that's straight line depreciation. Very, very simple. Okay. The next method I want to talk about is called the units of production method. The units of production method, just as the name implies, we're depreciating the asset based off of the number of units we expect to produce each year. Okay? So remember, I expected to produce 36,000 pairs of shoes over the life of the asset. The piece of machinery is expected to last for 5 years. I expect to produce a total of 36,000 pairs of shoes over the 5 years. Now, we already know that each year of production may not always be the same. Okay, so we need to figure out at the granular level the depreciation on a per unit basis. So the first thing we do, step 1, is we got to figure out the depreciation per unit. How do we do this? We take the cost of the asset, $10,000, minus the salvage value of the machinery, $1,000, divided by total units of production of 36,000 units. Okay, so that's step 1. which gives me about 25 cents per unit. Step 2 is I got to find the depreciation expense. It's based off of the number of units of production. That's why I call it units of production method. So we take the depreciation per unit from step 1, in this example 25 cents, times the number of the pair of shoes I produced in that year. Okay, the company is going to give us that data. We don't know how many pairs of shoes they produced, but I multiply depreciation per unit times the number of pairs of shoes I produced to equal the depreciation expense for that individual year. Now remember, the machinery is going to last us 5 years, so I do this every single year for those 5 years. So we need more data. We've got to figure out how many pairs of shoes we're making each year. So here we have the data. All right. So the cost is $10,000 minus the salvage value of $1,000. That's $9,000 total. Divided by the number of units of production, 36,000 units expected to produce over the 5 years. That's 25 cents per pair of shoes of depreciation. Okay. Step 2, find the depreciation expense for year 1. Depreciation per unit, 25 cents, times the number of pairs of shoes I produced in that first year. In this example, 7,000 shoes is the amount we produced in the first year. 25 cents times the 7,000 equals $1,750 of depreciation expense for that first year. Now, I can already hear you, Dr. B, that's not going to be the same every year, is it? No, it's not. Because we know that the company is not going to just produce the same level of production each year. So, year 2, the company produced 8,000 pairs of shoes. 8,000 pairs of shoes times the 25 cents is $2,000 of depreciation expense. I add that to year 1 amount to get my accumulated depreciation amount of $3,750. If I take my total cost, $10,000, minus year 1, $1,750 depreciation, that gives me a book value of $8,250. Year 2, the depreciation expense was $2,000. $8,250 minus the $2,000 gets me down to $6,250 book value. And then so forth and so on. You see how that works? So it's based off of the number of units we're producing per year times the depreciation per unit. And I do that over the course of the 5 years. At the end of year 5, my book value should be $1,000. Why? Because the piece of machinery has a salvage value of $1,000. That's how I know I did it right. That's units of production method. Questions? Units of production method, or were you okay? I know it's not that easy. We're doing all right? All right and fierce, huh? We good? Not talking to myself. We okay?
We are good.
Yes.
Okay, all right. Good. Yeah, you know, I care a lot about
Yes.
you all. I don't want to leave you hanging. You know, this is important stuff. And, you know, I'll tell you what, the reason why I go slow in the explanation, especially for units of production method, is because some students get real confused by it. So I want to make sure that we're clear because, you know, I don't want to leave you hanging. It's important. And it could trip you up. So that's why I go slow with it. So that's units of production. The third method is called the double declining balance method. Double declining balance method, okay? The double declining balance method, just as the name implies, is that we're doubling the declining rate, right? We're doubling the declining rate. We find the straight line rate and we double it. That's all it means, right? Real simple. So we can accomplish this double declining rate method balance in 3 simple steps. Step 1 is we got to figure out the straight line rate. Straight line rate is simple to figure out. We find the percentage. Yeah. So we take 100% divided by its useful life. That will give us the straight line rate, the percentage. Yeah. 100% divided by number of years, useful life. In our example, 100% divided by 5 years is 20%. 100 divided by 20 is 5. I'm sorry. 100 divided by 20, 20%. You see? 100 divided by 20, 20%. What am I saying? 100 divided by 5, 20%. 100 divided by 5, 20%. So 20% is our straight line rate percentage in our example. The second step is to find the double declining balance rate. This one is real simple. We take the straight line rate, 20%, and we multiply it by 2 to double it, right? It's real simple. 2 times 20% is 40%. Look how easy that is. Yeah? So, step 1, real straightforward. 100% divided by useful life. Step 2, double it. Double step 1. 2 times straight line rate. Step 3, find the depreciation expense. We do that by taking the double declining balance rate from step 2, 40% in this example, times the beginning period book value, the cost of the machine. Yeah? 40% times $10,000 is $4,000. So year 1, depreciation expense is $4,000. Pretty simple, yeah? Now, I can hear you, what about the rest of the years? Right? Right. Let's take a look at the rest of the years. So, we take the book value at the beginning of the year times the depreciation rate. Depreciation rate, decline rate, 40%. So 10,000 times 40% is 4,000. I take the 10 minus the 4,000 to get a book value of 6 for year 2. 6,000 times the 40% is 2,400 for my depreciation expense in year 2. Okay, 6,000 minus the 2,400 gets me a new book value of 3,600. 3,600 times the 40% is 1,440. 6,400 minus the 1,440 gets me a new balance of 2,160. 2,160 times the 40% is 864. 1,440 minus the 864 gets me 1,296 at the end of year 5. Depreciation is going to be 296. And would you look at that? The book value at the end of year 5 is going to be $1,000. That's how you know you did it right. Yeah. So just as the name implies, double declining balance method. So that's the method, real simple. Let's compare the 3 methods side by side. Side by side, okay? We've depreciated the same exact amount over the 5 years, 9,000, right? Because that's what we're supposed to do. The straight line method, as you know, is very simple. You take the total cost, depreciable cost, divided by the number of useful life, the years. Okay, great. It's 1,800 per year. Look at units of production. It's based by the number of units we produce. And then looking at double declining balance, just as the name implies, year one is pretty much double, right? And then it gets cut in half, cut in half, cut in half, cut in half, essentially. So in looking at that, we try to figure out which is the best for us, okay? The majority of companies in the United States use straight line method. The reason for that is because it's the easiest. That's it. It's the easiest one to figure out, right? Simple. Take the total cost, divide it by the number of useful life, years of useful life. Simple, real simple. So about 85% of companies use that because it's easy. That's their only reason. Now let's look at the other ones. Units of production, 5% of companies use that one. Double declining balance, 6%. And then there's a couple of other methods, accelerated rate method, etc., 4%. Now, if you look at these side by side, your company might have a different motive for using these. Here's what I mean by that. If your company's in manufacturing, you're probably going to use units of production. Simple, right? That makes the most sense, and it's probably the most accurate. But is it the best for taxes? Year one, it's not. That's why, when you select one of these methods for your company, you want to use the one that's best for you. Best for you, okay? So the majority of companies, for tax reasons, they might choose double declining balance if it's a new piece of machinery. Why? Because they'll take the biggest benefit from the taxes up front, right? Or they'll use straight line because it's easy. But this is why it's so important, because you want to compute it, run it side by side, and figure out which is the best for your company, because it's not always a straight answer. And yes, you can use different methods for different things. Because like if you have a lot of pieces of machinery that do the same thing, you can use different methods. It's again, whatever makes sense for the company. So as I had mentioned, the maker's report for tax purposes, modified accelerated cost recovery system, that's what we call the maker's report. This report often tells us how things have their useful life, but you'll notice that it allows straight line depreciation for some assets, but requires accelerated for others. Reading this report is good bedtime material. It's really boring, but it's important for your business if you want to figure out how long things should last and what's the most appropriate way to depreciate it. Sometimes there might be changes halfway through the year. Yeah, it's totally possible. Why? I sold the piece of machinery, it broke down on me, wouldn't work, whatever reason. Business changes, right? So we need to adjust for those kinds of changes. So here's an example. The company, when a plant asset is purchased during the year, depreciation is factored. So let's say, because oftentimes we don't always just buy stuff January 1. We're going to buy it in the middle of the year, right? We're going to buy it on a random day during the year. But I still need to make sure that I calculate my depreciation expense based off when the machinery is in service, when we're using it, yeah? So let's say I bought it in September, I put it into service October 1. October 1, 2020, I got October, November, December. That's 3 months of depreciation I need to account for. So to figure it out, it's pretty simple. We just take 3 divided by 12, and we multiply that by the 9,000 over 5 years to get $450 for those first 3 months. But you see how that works, right? Or you can just divide by 12 and get per month basis, and then extrapolate it out that way. But the point is that when the machine goes into service, that's when you need to start depreciating. Other reason for estimate changes, useful life changes, salvage value changes, or a change in the estimate of production. You see, all these are factors for changing, and so we need to make adjustments to things like useful life, salvage value, etc. Because things happen, especially in manufacturing. So that same piece of machinery, here we go, something happened to it. Uh-oh. A couple things happened to it, it looks like. Well, we thought it was going to be $10,000. We thought it was going to have a salvage life of 1,000, salvage value 1,000. We thought it was going to last 5 years. Those are all estimates, right? Well, we found out that that's not the case, so we got to adjust. The value at the end of the 30 years is actually 6,400. We realized, oh, the salvage value is not going to be 1,000, it's actually going to be 400. So we adjusted downward, 6,400 minus 400, and it's actually going to last 4 more years. Okay, at the end of year 3. So, okay, no problem. So we adjust. We make those adjustments, and we recalculate our depreciation per year based on those changes. The point is that you update your depreciation schedule accordingly when changes happen. When it comes to expensing things, we talked about depreciation expense, and the reason why we do that is because we need to depreciate the value of our fixed assets over time. It's important to understand the differences between what we call your regular expenses and your capital expenditures. These are different things, okay? Your regular expenses, we call those revenue expenses, right? They're your day-to-day operating expenses. Real simple. Day-to-day operating expenses, we call those revenue expenditures. They're just operating expenses. It's the day-to-day stuff. And those day-to-day things, they don't have an impact on things like property, plant, and equipment, useful life. They just don't. It's kind of like doing maintenance. You're changing the oil on the piece of machinery. Changing the oil is not going to make it last longer. It's just going to keep it running. Okay? If you want it to last longer, you got to do something big. You got to replace the engine. That's going to make it last longer. Replacing the engine, we call that capital expenditure. A capital expenditure, also known as a balance sheet expenditure. This is when we're adding benefit. We're adding benefit or value to the asset. This would be something like an overhaul to the engine on our equipment. That's a big expense, but it's going to make the equipment last longer. Call that a capital expenditure. If that makes sense. How do we identify between the two? Ordinary repairs and maintenance, that's just a simple expense. Repairs and maintenance, we do that every day. We fix broken windows, we take care of the oil on the machine, we tighten the belts up, make sure it's going to keep working. That's just regular repairs and maintenance. Okay? It doesn't extend its useful life, it just simply makes it work. Yep. That's revenue expense. Capital expense is a major overhaul, like replacing an engine in the machine. That's a big deal. Okay? And when we replace the engine, we expect it's going to last longer. Yep. Call that an extraordinary repair. couple of examples of each. Regular repairs and maintenance, real simple. We just debit repairs and maintenance expense and credit cash. Change in the oil, $9,500. And then sometimes we might have an improvement. When we're improving the asset, it's going to last longer, so therefore we increase the value of the asset. So here we have engine overhaul, we'll say. We debit machinery, $1,800, credit cash, $1,800. And one of the last parts I want to talk to you about these fixed assets is what happens at the end of its useful life. At the end of its useful life, we're either going to dispose of it or we're going to scrap it. Okay? We're either going to dispose of it or scrap it. Now, the reality is, in most businesses, we're not getting rid of the machinery. That would be silly. We're going to keep it going. Okay? It reached the end of its useful life in 5 years. So be it. All I'm going to do is I'm going to quote unquote dispose of it by taking it off of my books. I'm still going to use it. Okay? It's just not worth anything, but I'm still going to use it. Okay? That's called disposing. Or it could also mean the actual disposal, getting rid of it. But either way, at the end of the useful life, we either have to dispose of it by getting it off of our books, or we need to scrap it. That also involves getting it off of our books. So there's a couple of journal entries we got to make in order to make this happen. All right. To remove the accumulated depreciation, we have to debit that, and we also have to credit the asset. What this does is it takes it off for our books. That's a reversing entry. At the end of the 5 years, I make a reversing entry. Debit accumulated depreciation, $10,000. Credit machinery asset, $10,000. Now it's off my books. Right? Simple. If I dispose of it and I'm going to make some money from it by disposing of it, I debit cash and credit either a gain if I'm gaining on it or loss if I'm losing on it. You see? So when I just discard or remove a plant asset, if the cash I'm receiving is greater than its book value, it's a gain. If the cash I'm receiving is less than its book value, then it's a loss. If the cash is equal to its book value, there's no gain or loss. But I still need to make those those journal entries. Here we have an example where I am disposing of a plant asset that has been fully depreciated. So here, again, my piece of machinery cost $9,000, cumulative depreciation $9,000 at the end of year 5, useful life. I debit accumulated depreciation, credit machinery. What this does is it takes it off my books. Very simple. It's just like a reversing entry. Here I have the asset has not been fully depreciated, but we're going to get rid of it. Okay, we don't need it anymore. You know, here we are, year four, we'll say. I don't need it no more. It don't work the same way. I just don't have a use for it, whatever. Okay. So in this example, machinery costs $8,000, has a useful life of 8 years, salvage value 0. So 8,000 divided by the 8 years is $1,000 per year. I record the depreciation expense as I normally would do, except it looks like I'm getting rid of it in the middle of the year on July 1. So I'm going to debit depreciation expense, credit accumulated depreciation for half the year, 6 months. And then I'm going to get the piece of machinery off my books. I debit accumulated depreciation. I'm going to debit the loss, which is the difference, right? And I credit equipment. Here I'm getting rid of my equipment at book value. Okay, so in this example, the machinery was 16,000. Accumulated depreciation is 12,000. I'm using straight line method, 4,000 per year. So here we can see that was it 5 years? Got 1 year left. I decided to sell it for 3,000. Okay, instead of using it for that last year. So first transaction is I'm going to recognize the 3 months I had it and that 4th year. Debit depreciation expense, credit accumulated depreciation. And then the second step is I'm going to debit cash for the amount I sold it for, debit accumulated depreciation, and credit equipment. In this case, there was no gain or loss. It was at book value. And lastly, or well, almost lastly, if I sell it above its book value, I'm going to get a gain, which is great. Debit depreciation expense, credit accumulated depreciation for the amount of time I used it for during that year. I'm going to debit cash, debit accumulated depreciation, credit the gain on the sale of the equipment, and credit equipment. And then lastly, if I sell it below its book value, I don't like to do that, but sometimes you have to. Debit depreciation expense, credit accumulated depreciation for the time that you used it. Second step is debit cash, debit the loss on the equipment, debit the accumulated depreciation, and credit the equipment. Yeah. Okay, so look, we talked about property, plant, and equipment. We talked about the depreciation of property, plant, and equipment. And one of the last parts of this is talking about natural resources and the depletion of natural resources. Some businesses are in the business of mining, pumping, cutting, etc. This would include like a paper company deforesting to make paper, or a coal mine to get coal out of the ground for heating, or for whatever, right? So we use earth, we use Mother Earth in order to create things. Yeah. And so if you're in that kind of business, you need to recognize the depletion over time, the extraction of those resources over time. So you need to, just like we do with depreciation, you need to do it the same exact way for the use of natural resources. So we have the cost of the mine minus the salvage value divided by the total amount of extraction units. We take the extraction or depletion per unit times the extraction during the period. So it's very similar to units of production. We do the same process, units of production. We use that same process for something like mineral extraction. And this is just an example of that. We just go through the same process of depreciating the use of that material. Just another example of it. Very straightforward. So, and then the very last part, I promise, is accounting for the intangible assets. Intangible assets are the things that you cannot physically touch. Okay, this would be things like patents, copyrights, franchises, trademarks, goodwill, leases, leasehold improvements, or other things like research and development. We record them at their cost when they're purchased, and they do have limited or indefinite life. Like, for example, a patent is only good for, I think it's like 20 years, 10 or 20 years, whatever the patent office says. So you have to record that as its useful life. But it works very similarly for depreciation or amortization. Yep. It works the same exact way. We record it at its cost plus purchase price, legal fees, filing fees, etc. That's our total cost. It has a useful life or limited life. And so we take the cost divided by its life, and that gives us our expense on a per year basis. That's basically what that tells us. We do the same type of thing for goodwill and leases and research and development. And of course, it wouldn't be an accounting class if I didn't give you at least one ratio. So here we have a asset turnover ratio. The turnover ratio, very simply put, tells us how efficient the company is at using our fixed assets to help us generate sales. We take net sales divided by average total assets. Average total assets is found by taking the beginning balance total assets plus the ending balance total assets divided by 2 to give you your average total assets. And then sometimes there might be exchanges. You might trade with a company land for a building or land in a building for the exchange of equipment or whatever. So just some things that may or may not happen in business when it comes to purchasing a piece of land. There might be a trade involved or something like that. Yeah. So that's just kind of what this part talks about. So the accounting works the same exact way. We just add in that factor. So that brings us to the end of our discussion on property, plant, and equipment and the depreciation of property, plant, and equipment. Are there any comments, questions, or concerns that I can help to address at this time? You're all good.
No, Dr. B.
Amazing. Amazing. Okay. So the next couple of weeks are going to be very interesting for us. Next week, I have a meeting that I need to be at. I'm pretty sure during the same time as this class. So I don't know if I'm going to be able to hold. I'll try to, but I don't think I'm going to be able to make that one. And then for November, November 5th through November 25th, I am going to be in Medellin, Colombia for the Fulbright Scholarship Program, working in Colombia alongside some researchers there. We're working on a very big project for environmental social governance, which is directly related to accounting. So I'm going to be there leading a team of researchers. And we'll be doing everything in Spanish. So I'm going to try to hold class during those weeks if I have the time to do so. I have an apartment there, so hopefully it has good internet. And if so, then we'll still hold class. If there are challenges, I will post the videos. But either way, don't worry, I'm not leaving you. I'll never leave you. I won't do that to you. I'm going to be here every step of the way, like I promised you in the beginning. So I just want you to be aware that the next few weeks are going to be probably a little different. There might be a few weeks where we might need to post the videos, but the plan is that we'll still try. We'll still try, okay? But I just want to let you know what was up. I don't want to leave you behind. And then just the two things for this week, you got the hypothesis and the quiz. Any other comments, questions, concerns?
No, thank you, Dr. B.
Thank you, Dr. B.
Yeah, it's my pleasure. Hey, you know what? I try to always be here for you all and do right by you. And I appreciate that. I appreciate your hard work in this class, and I know that you're all doing very well. So, listen, if you ever need anything, you know how to get me. You can email me, call me, set up office hours. Hey, my phone will still work in Colombia too. So, if you just give it a ring or whatever, or you can send me the WhatsApp, or you can always email me. That always works too. So, I'll be there. But thank you so much. I
When are you
appreciate.
going to Columbia? I'm sorry, I missed that part, Dr. B.
I'm sorry.
When are you going to Columbia? I missed that part.
Yep, I'll be there from November 5th to November 25th. So
Okay.
about 20 days. So, but we'll still try to make the whole class thing work. Okay.
Okay.
It's on the same time zone, same everything. So it'll be okay.
That's
Okay.
cool.
But thank you all so much for your time. I sincerely appreciate all of you, and have a wonderful rest of your night. Thank you again.
Thank you, Dr.
You're
B. You
welcome.
too.
Thank you so
Thank
much.
you for your time. You have a
Hey.
good one.
It's my pleasure. Thank you so much. Thank you.
Hey,
Thank you.
Dr. B.
Thank you.
I was gonna say